Today I want to teach you when not to trade. There's some times in the market where you should not trade because you want to be able to not have too many losses and you want to conserve your capital. Now this is exactly the time. I'll show you in the chart what I mean. So let's get in that video. What's up, traders? Welcome back to Bangkok in Thailand. Today I want to teach you, as I said, how to not trade in some times. What are the 3 things that I look for not to trade? But the issue is that you kind of gain them only with experience. So these are not things that I learned from the start. These are things that I learned like way far in my trading journey, about like 4 years into my trading journey. So I want to teach you how that works, and we'll go to some chart, of course. I want to show some examples for each of them. So the first moment when not to trade is quite simply in low volatility. So we've seen the market with really volatile moves and some low volatility moves as well. So we want to understand how that works and when to trade, when not to trade. So let me give you an example. So here we are on USD Japanese yen, and you'll see this pair is quite sometimes volatile, quite making big moves too, but it's also very often consolidating and basically doing nothing. So I'm really back in time here. I'm in 2013, and what happened is basically we had these kind of movement on the pair, and that was fine, and then we had this big push to the upside. Following which price kind of went up again, and then we have what we call a triangle right here. Okay, that's so far as I'll find. Also think you can trade there. That makes sense. But we get to here where here's a really tight range, and we didn't have that before. This is like from January to all the way to here, June, where price pretty much didn't do anything. And you have like a tight range. You could trade this maybe on a really low time frame, like a 30-minute chart or something, and that will work fine. But for most swing traders, that would not work out fine because it would be stopped out all the time here. Even though you might have setups that are perfect and that look really good, you get stopped out at any occasion because of the fact that price just goes up and down, and it just kind of stops everyone there. So that's one of the places where you would not want to be placing trades. You would want to step away for some time and look at what's happening on other pairs and maybe come back later when we have this breakout here. So see how price break out, and then we have like moves that are much bigger. These candlesticks here, we had a pullback to the zone, really strong, a big move to the upside. So that's what we look for. The thing is, you could place as many trades as you want, of course, but you're not gonna make any money if you don't have big moves or some kind of move in place. So if the market doesn't do anything, you're not gonna be paid, and you're wasting your time. So just to be clear, the way you look at volatility here and the movement in the pair is simply how far the price goes. So if it's in a small range and there's no place to trade, and there's barely like one candlestick high, see, like for example here, this candlestick is like one candlestick is the top of the range, right? So this one here goes back to the bottom, this one here goes halfway, a little bit more higher, pretty much at the top, and then boom, one candlestick, we're at the bottom of the range. So if you have something like this where you have only 1, 2, 3 candlesticks from top to bottom, it's a really bad place to trade. Now, the second thing we'll look at here is the opposite of that. So high volatility and big ranges in the market. So it's something good when you have some volatility, of course. You want to have that to be able to have big moves and trade the big moves. But the issue comes in when you have a lot of wicks and you get trapped out like all the time. So I've got 2 examples for you here. So the first one is on GBP US dollar. And you'll see that we have a lot of wicks here to the upper side. So price went up and then came back down. Now, we still move upward anyway with these kind of candlestick over time, but you have to notice that the sellers here were really in control with that candlestick. And again with this one here, we have wicks, and maybe again with this one here, see all these big wicks, and maybe again over here, right? And so now we get to a point where we have these set up in the market, and they kind of look good. We have this first one here, which is with the Bollinger Band, which I would normally trade. Except that if I'm somewhat smart and a little bit looking at the chart properly, I would have 2 things here preventing me from taking the trades. The first one is, yes, we have like a really big engulfing, and that's fine. But the issue is that we have a really big wick here. See how this is like almost as big as the candlestick before. Now we have to look at the action of the candlestick, what price does there. So it tells us that price starts here, moves down, okay, like here, and then recovers all the way here, okay. Now, what does that mean? Of course, it's a bearish move, right? We're going down. But it also means the fact that the buyers recover pretty much all of that. So it's not really a good place to buy or sell, do anything. So if you were to enter price there at the bottom, actually the bottom would be more here, then yeah, it goes in your favor. But you have so many wicks. You have a second one here after that on the entry of the trade. Let's just clear it up a little bit. So you've got two wicks, this big one and this big one right here, where even if you enter the trade there, price is gonna trigger, of course, in the trade. But then after that, there's so much pressure by the wicks and everything that price just go back against you. And we have a ton of examples like that too. Here's one that would be a little bit tougher to predict. So on the same pair, a little bit later on the 1 hour chart, price makes an upward trend. It seems like it's continuing quite well. So some people might be tempted to short that pair because they want to be reversal traders. And then we have all these wicks over here. We have this engulfing candle, which is a really nice setup. And I would definitely take that if it was at the right zone. And you went below the low, but then you stepped out right after with this big wick over here. So price in this market is kind of likely to make big wicks, as we've seen in the past, and here also. Which means that you might be more careful. You might try to put your stop loss a bit higher if you want, or you might just try to avoid the market a little bit more for some time. But the other thing to consider is that if price is trending, don't go against the trend, right? In most cases, unless you have a zone or something. Here you have a nice setup here with the trend, and that will be fine. But even if they were sideways, you cannot trade them when they have big wicks and a lot of volatility, of course. So for candlestick, for low volatility, look at a candlestick. The bodies of candlestick, where they go, and then for high volatility, you have to look at the wicks and how big the wicks are. Now, the third thing to look at, and the third place where I don't trade at all, is when zones are broken multiple times. And we have a pretty good example of that on GBP and ZD, where we have a really good zone here at 1.99, or you could say it's 2, it's fine, on a weekly chart. And price in the past seems to have respected that zone quite well. We've been here, we touched near that zone, came back here, touched the zone, here we broke out, but we kind of had this zone here that we followed and that we respected a little bit more. Now we have another zone here, of course, at 2.10, but this zone was still pretty major. We came back here, touched it again, touched it again. Okay, I'm not going to do this for all of them, but we touched it many times. Now if you move forward, this is back in 2013-14, okay? If you go forward, we touch it again, we come back, we start to kind of follow the zone a little bit less. See how we have these moves there that are kind of breaking the zones many times. And that can be fun a few times, but look what happened after. We break the zone, and that seems to be fun. Now we come back. Now we seem to respect it a little bit more here. Now this is also respected quite a bit, but we have this big move there that goes and break the zone. Now we respect it really well here. This is really good. Okay. Now here we get to a point where, and this is today, so we kind of go upward, we come back down, we come back up. We do respect it a little bit here, but we don't have the same level of price respect the zone at this point. So we've been up and down, we've been like a little bit messy, and especially this pair has a lot of big wicks as well. So we've been many times where we could place trades at the zone, like this one here, and we could be stepped out right after. Okay. Or maybe you want to trade here. This one was kind of fine, was decent, this support here. But then we don't have any places where price looks really good. So in those kind of cases, I would tend to avoid the pair a little bit more. I would tend to stick to other pairs that are more predictable and respect the zones better. There's plenty of examples of pairs that really follow the zones well. And they might break out a few times and everything and not respect it, but most times they respect it more. So you got to be able to maybe put this pair away where it doesn't respect the zone and focus on something different. Now here you might say, yeah, price goes back down because of this engulfing candle, price goes back down. It could happen, but what tells you that price is not going to come back after and go up? So what I've learned in the past and what I told you today is the fact that even if you have a strategy where you actually take profits pretty quickly, like you have a break even, maybe move your stop loss to break even or something, you should not take any trades because of that. Like even though you can be break even quickly, a break even trade does nothing, right? You're basically entering the market and then you go out, and then you got nothing. So I hope that makes sense to you. Toss us in the comment section below. I want to hear your comments and what you think about these tips on how to not trade, and what are the moments where you should not place trades in the market. Here are the few comments for the past video. I appreciate your comment as always in the comment section. And don't forget to share this video with people that might benefit from it. I would really appreciate that. If you can share this knowledge and be able to impact more people, that would be awesome for me. So please share this with other traders that you think might like those videos, and I'm going to be very thankful. And by the way, I'm moving apartments. This is going to be the last video in this apartment for now. I'm moving to a new apartment pretty soon, actually today. So I'll catch you back there pretty soon.